Okay, let's unpack
Let's
this.
do it.
Our mission today is a deep dive into California's commercial real estate market. We're looking at the data for November 2025, and the big idea here is that we're past the great bottoming.
Way past it. We're now firmly in what we're calling the Great Divergence.
A great divergence, so a split.
It's truly a split market. I mean, that's the
That
most crucial takeaway for you. Up north, you have what feels like a NorCal 2.0,
driven by AI.
almost entirely. It's this accelerated expansion from the generative AI boom, which is just, eating up office space and driving multifamily rents through the roof.
In down south.
Down south, it's more SoCal normalization, a much slower, steadier recovery. It's defined by getting over that industrial oversupply hangover in the Inland Empire and dealing with that stubbornly high office vacancy in LA.
So the foundation feels stable. Our sources are saying the state economy is holding on, no recession in sight, even with budget deficits. What's the engine then, the statistical driver behind this split?
Okay, here's where it gets really interesting. It's all in the job growth numbers.
Right.
The information sector is just booming. And those are the high-paying jobs filling up offices and apartments in San Francisco and Silicon Valley. That's the whole NorCal engine right there.
And the rest of the state.
Well, you've got sectors like education and health services, leisure and hospitality. They're providing this widespread but much slower demand. Good for medical offices, great for neighborhood retail. But it's a tale of two very different speeds.
And it seems like capital is finally catching on to this story after, a 24-month stalemate.
Yeah, a long freeze. But price discovery feels complete now, and the money is absolutely flowing again. Debt origination is up a stunning 48% year over year.
So the market is thawing, but the money is being surgical.
Very surgical.
Yeah.
Sophisticated capital is aggressively betting on what they see as the bottom, but they're not casting a wide net at all.
Wait, let me just stop you there. Something in our notes jumped out at me. Office sales activity saw a 36% year-over-year increase. It's leading all asset classes.
I know.
Office. I mean, isn't that the dead asset class everyone was running from? Who is making that bet?
It's a really calculated contrarian bet. It's focused on two things. First, trophy assets. Think the $205 million sale of Maple Plaza in Beverly Hills. Premium space that always holds value.
Okay, so the absolute best of the best.
Exactly. And second, they're picking through the distressed opportunities. Right now, there's about $573 billion in maturing loans that are considered at risk. So it's not a broad recovery. They're betting on the best and the most broken.
And this divergence, it just becomes undeniable when you look at the extremes in asset classes. Let's start with industrial.
The big correction.
The Inland Empire produced this jaw-dropping statistic. 0 new warehouse projects broke ground in Q3 2025. That hasn't happened in 20 years.
And that's just developers rationally hitting the pause button. They know they oversupplied the market, and now they're just letting tenant demand absorb the glut. It's the smart move, frankly.
Now contrast that with multifamily, completely polar opposite.
A whole different ballgame.
NorCal is just utterly demand-driven. San Francisco saw rent growth of, plus 7.8% year over year, and vacancy just plummeted to 4.4%, the lowest in a decade.
And that's a direct line from AI workers flooding into a market with near zero supply. But see, down in SoCal, it's a supply story. LA rent growth was basically flat, 0.5%, because new supply, 4,300 units delivered.
Just swamped the demand.
It vastly outpaced absorption. And that issue, that lack of housing, leads directly to the next phase we're seeing, legislative change.
Right, which brings us to the new mandates. AB 1050 feels like a major catalyst for developers.
It is. It expands their ability to legally remove restrictive covenants from commercial properties. I mean, this is huge. It really unlocks a new wave of adaptive reuse.
It makes turning those empty offices and malls into housing actually viable.
Legally viable, yes.
Then you have the green mandate. California's SB 253 and SB 261 laws are now the de facto national climate standard, right?
They really are. And it forces large tenants to report their Scope 3 emissions, which, crucially for us, includes their building leases.
So the dumb building is obsolete.
Completely. Owners must adopt PropTech now, smart building systems. You have to be able to measure and report energy use. You simply cannot attract a large, compliant tenant without that data. It just accelerates the brown discount for older, non-compliant buildings.
So what does this all mean for you listening? It seems like the 2026 market will reward surgical precision.
Not broad bets, no. The strategy is pretty clear. By the divergence, that means those NorCal tech hubs or the SoCal trophy assets.
And Operate for the future. Prop tech isn't a luxury anymore, it's mandatory.
Absolutely. And I'll leave you with a final provocative thought to mull over. Consider the new tenant protection law, SB 1103. It extends protections to what they call qualified commercial tenants, so microbusinesses, small restaurants. Will the new administrative burden, the new compliance rules, actually cause cautious landlords to just avoid leasing to the very small businesses the law is trying to help? It's a real question of unintended consequences, something to think about.